Hello, good morning, good evening, or good afternoon. Welcome to the Income ETF channel. We are going to discuss about JEPY Exchange Traded Fund, which is also known as the S&P 500 Enhanced Income ETF. Let's take a look. This exchange traded fund provides a distribution of 72%. Wow, 72% a year, and monthly around 3.9%. Okay, let's go down and check the details. This is the first put right ETF on the S&P using daily option to seek enhanced yield for investors. So that explains some part of why the high dividends, and it's paid monthly. Okay, and the fund's primary investment objective is to seek current income. Secondary investment objective is to seek exposure to the performance of the S&P index. So basically, what they are saying is the main objective is to seek current income, and the second um, goal is to provide capital appreciation depending on the performance of the S&P index. So that's those are the two main goals of the fund. And let's go down and look at a few basic details. Here it says net asset value 43.23, closing price 43.19, and all the basic stuff, basically net assets 97 million, and ticker and other information. The key thing we are looking for is the expense ratio. Expense ratio is 0.99%. That's the fee you're paying for investing in this fund. And yeah, this is the basic information we have here. And let's see what the fund invests in. What is the portfolio or the basket of investments? Let's go a little bit further down to see the top holdings. So if you see this fund, you have United States Treasury note bond, which is giving some interest, 0.75%, and 11/15/2024 is the expiry date, and this is the market value. So basically, they have around 31% in this US Treasury bond or note. And when you go further, you have three other bonds they invest in. So if you add up all these 31, 30, 30, another 6%, you have like close to 97% ish in treasury bonds. The reason is they have a lot of cash which is invested in these bonds until they find a good investment opportunity or a option to write calls. So there's another 3% which is into cash, and a small percentage into another treasury equivalent fund. And you have this SPX, which is the call writing trade that they have shown here. The SPX option expires on 9/16, September 16, 2024, and the put, basically not the call, it's the put that expires at on the September 16th, and it has a strike price of 5635. So that's the position they have taken here. And so the holdings are a combination of all the US Treasury bonds, cash, and the put option. So this is where the uh, put writing income comes from, and there is a small income that comes from the interest earned from all these bonds, not much, and that is used also for the trading or their collateral for their you know option trades. Now the biggest question that all of us have is how the hell they make the 72% distribution. Let's take a look here. Let's go down to the distribution section of the web page here. When I go here, I can see that the distribution started in September 2023 for 90 cents, and it went up to 91 cents next month and goes on like that in 2023. And here 2024, the most recent was $2.75, and there was this reverse split. So it's a little bit of a math that we need to do to find out what the real distribution is. So, to know the real distribution and also to know how much you can expect to earn, please stay tuned till the end of the video. So, let me quickly show you because the math is going to be a little tough. Like the fund has been in the market since last year, like roughly about 12 months, 1 year. So, we have sufficient data to make some kind of judgment on how much they have made. I will just show you my sheet, which talks about JEPY and the yield that they're making. Hey, let's look at the math now. JEPY, the price is 43.19 cents as of 13 September. And I have pulled up all the dividends from the other uh, page which talks about distributions here. I pulled up all these distributions and put it on the sheet just to make it easier for the calculation. And here you can see the dividends. I'm going to just zoom in a little bit on the left side. You can see all the historical dividends starting from 2023 October to September 2024, all the way down. And so when you look at this, the total dividends for the last 1 year or 12 months comes up to $23.83, close to $24. And when I do the math, like the dividend yield for the whole year comes up to about 55%, like 55.18 to be precise. And let's look at the what the story would have been had you invested in this fund 1 year ago. Of course, you made a dividend yield of 55.18. That's one part of the story. But let me explain to you the other part as well. I will go here to my 1 year story to just give you the real picture here. So 1 year ago, had you invested in this fund, JEPY, you would have picked it up at $60 roughly. It's 60.01 to be more precise, adjusted for splits and all that. Because when they launched the fund, they launched it $20, and a few weeks ago they did a reverse split, and which tripled the basically the price of the ETF and reduced the quantity of shares. So so after that, the price at the launch of the fund would be $60, and the current price is 43.19. So essentially, you can see here that you are losing on the capital appreciation front. Basically, price return wise, you're losing about 28%. Like basically, you lost money on your capital. However, you made money on your dividend yield. I said before that you made a dividend yield of 55%, right? So I put that here. So let's put it all together. Like if you look at it, price return and dividend put together as a total return, you are making about 27% for the 1 year, like for the last 12 months, which is a very good performance for a income ETF, and that too is paying you monthly. The only concern is you are losing the price wise, the NAV erosion, 28% erosion here, but you're also getting paid here. So if you are getting paid and then you're eroding a little bit and the total return works out positive, that to 27%, I think that's a wonderful performance. However, when you compare that with what's published on the website, which says that it's a 72% uh, yield here, like you see a 72% here, that's not the real yield that you're getting. You're getting about 27% net net on the total return basis. So that's what you can really look at and expect. This is the real number in terms of the returns. However, let's look at the how much you would have earned. Like let's say if you invested $5,000 in the fund. So based on the same numbers and whatever you earned, you would have made annual dividends of about 2,758. So within a year, you're getting back almost 50% of your investment, and on a monthly basis, you're making about $230, $230 roughly, which is excellent, wonderful. Now that's 1 year story past. Now what about now and what about the future? Like what can you expect, or what kind of scenario we can look at? There can be various scenarios. If the same situation continues, you make the same yield and you have the same amount of investment, you can expect the same kind of dividends. I would say this is like a moderate kind of scenario, like if everything continues in the same way, uh, same case scenario, you will get the same kind of dividends roughly. But let's look at a conservative, more, more sharp and more conservative analysis. So what I did here is, when I looked at these dividends, all these dividends, if you closely observe, like in September 2023, they paid $2.70. Similarly, in the next month, then December 2023, it dropped to $1.95. And if you keep moving down, you see the dividends coming down, $1.50 and $1.74, $1.80, and so on. And then there's a jump here. May 2024, it moves up to $2.28. And then again, it drops down. And recently, September 2024, they paid a big one, that is $2.76. It's all over the place. Moving up and moving down. The minimum that they paid was around July 2024, when volatility was pretty low. That was $1.39. So let's assume a kind of low dividend scenario. Let's say if they make less income in option writing, so they can afford to pay, let's say, a low dividend. That low number could be somewhere close to this $1.39. I'm not saying that this will be the future performance, and this is not investment advice. Please note the disclaimer: this is not investment advice. Do your own research or consult with a financial advisor. But based on the numbers data that we see here, $1.39 seems to be the kind of a rock bottom dividend base that they can produce every year consistently. That's what we are hoping for. It's just a estimate. Now, keeping that $1.39 estimate here, I'm able to see that in a year I'm making 38.5% returns. Like, it's like 38% a year means like close to slightly above 3% every month you're making, which is a great return. Um, and if this continues, and let's assume on an average you're making this much, your annual dividends are expected to be about $19.25, and average monthly earning would be about $160 based on the 1925. So basically you're making 1925 a year and 160 per month on the same 5,000 investment. That's what you can assume as a conservative scenario in the future. How good or how bad this is, that only time will tell. But if this return is achieved, it is definitely a good return, and it's worth investing in this fund. Now, on its own, JEPY is a good fund, and now it seems to be performing well. But how does it perform when compared to the benchmark? Like when we compare this with another fund, let's say we compare it with IVV, which is the S&P 500 ETF, which tracks the S&P, which basically mirrors the S&P, like exactly moves in tandem with the index. Uh, this fund provides a yield of 1.27%, let's say 1.3 to make it simple. And let me do the 1 year story here. 1 year story for the fund shows that the fund started at, if you bought this fund 1 year ago, you bought it at 448.46 cents. Today it is 565.05. You made a price return of 26%. You made a big 26% here, whereas in JP you made a negative 28%. That's because of NAV erosion, and that makes a huge difference. Investing in the index ETF provides you all the full capital appreciation, whereas investing in the covered call ETF is going to give you kind of lower price appreciation. In this case, it's a negative one. That's a drawback. In terms of dividend, it's the opposite. The index ETF is giving you a 1.3%, hardly beats the inflation, and JP is giving you 55.2%. And and if you look at the total returns now, 26 plus 1, it's 27.3 for the index ETF, which is IVV, which is the iShares S&P ETF, whereas JEPY is giving you 27%, which is exactly in line with the index ETF. So it's not giving you higher income, nor is it giving you a higher capital appreciation. Net net, if you compare, it's going to be the more or less same in terms of total returns. We think, like generally speaking, experts say that covered call ETFs are going to underperform the index. Probably it underperforms, overperforms, outperforms. We don't know. Only time will tell that. But here it seems that JEPY is in line with the index ETF performance. And if we do the same comparison, like if you are investing $5,000 in each of them, in IVV you're getting annual dividends of 63.61 cents, and in JEPY you're getting dividends of 2,000. Whereas in terms of quarterly dividends, you're getting 15.90 cents, $15.90, and here $230. The only difference I see is JEPY is giving you more income upfront, whereas uh, the index IVV is giving you more price return. Um, so it's just the way the return is structured. Basically, someone looking for an income would move to JEPY, where someone looking for a capital appreciation or um, increasing the value of their investment or NAV over time, they will look at uh, IVV. A growth investor would look at IVV, whereas a pure income investor would look at JEPY. And someone who is wants a mix of both, like hybrid investor, would could probably invest a little bit in this and a little bit in that, and get the best of both worlds. All the possibilities are on the table. Like whichever way you want to go, you can do that. And if I go with the conservative yield on the IVV, I'm getting a yield of 1.1%. That's the minimum yield I will get after doing all my math and calculations here, taking the minimum dividend into account. Like based on the minimum conservative yield, I'm making 1.1%, very low in terms of yield, but good in terms of capital appreciation. And annual dividends I'll make is around $57, 57.03, and quarterly I would be making around 14.26, um, which is a smaller amount compared to JEPY. Like in JEPY, you're making around $160 per month, but here you're making 14 per quarter. Like so, yeah. In JEPY, this 160 is per month. So comparatively, if you look at it, like it's just the way the returns are structured, like I mentioned here. That's the clear difference between IVV and JEPY. And so JEPY effectively is giving you a 27% total returns. And in terms of yield, you might be getting a slightly higher yield because they are paying it every month, and it is paid out then and there. Like so, some part of the NAV is getting paid out back to you, so that inflates the yield that you're receiving, even though you're taking a conservative number. So effectively, like whichever way you look at it, the person who is looking at income investing, income basically, they would look at JEPY. The person who is looking at growth would look at IVV. That's the bottom line. So so just to conclude that you never judge any exchange traded fund or any fund based on the published yield, because they even put a disclaimer here saying that this could be varying, or this is calculated based on the latest distribution. So when you look at the distribution, I would always suggest take an average, or some kind of a number which uh, takes into account the historical data. So when you look at that, you get a yield of 27% for JEPY, and which is like close to 2% plus per month. And that's still a very good yield, like which investments offer you 2% every month consistently and paying you every month. So that's the beauty of this cover call ETF, income ETF. And I hope you enjoyed this video, and hope to see you in the next one. Please share your comments, feedback, or any other thoughts that you have about this video. I'm looking forward to hearing from you. Thank you.